Have you ever looked at a company's financial report and just felt completely lost? Like you're trying to read a secret code? Well, today we are cracking that code. We're going to break down one of the most powerful financial tools out there, the balance sheet. Let's jump right in.
So I want you to imagine this. What if a company could take a selfie? Not, a picture of its headquarters or the CEO, but a selfie of its total financial health, frozen in a single perfect moment. Well, that's it. That is exactly what a balance sheet is. It's a snapshot, a financial picture that tells you pretty much everything about where a company stands on one specific day.
And that idea, that concept of a snapshot in time is so important. It's really the key to understanding everything else. So it's the perfect place for us to start.
Right, so when you look at any balance sheet, the first thing you'll see is a date. It'll say something like, as at December 31st. And that's absolutely crucial. It means every single number on that report, every asset, every debt, is only true for that one day. A minute later, things could already be different. Maybe they made a huge sale or paid off a loan, but this document, it captures the company's financial pose right at that exact moment the camera shutter clicks.
Okay, so how is this financial picture even structured? Well, it all boils down to one simple, kind of beautiful, and totally unbreakable rule. This is the absolute bedrock of accounting.
And here it is. Assets equals liabilities plus equity. Let's break that down. Basically, everything a company owns, that's its assets, had to be paid for somehow, right? It could only come from two places. Either the money was borrowed, which creates a liability, or it was funded by the owners, and that's the equity. The equity is the owner's true stake in the business. And this equation, it has to balance, always, to the penny. It is not a guideline, it's a law of financial physics.
Now, you might see this laid out in a couple of ways. There's the old school account format, which kind of looks like a big T with assets on one side and liabilities and equity on the other. But honestly, the one you're going to see almost everywhere today is the report format. It just lists everything straight down, one after the other. Same info, just a cleaner, more modern look. All right, let's start pulling this equation apart, piece by piece. We'll start at the top of the report with assets. This is all the good stuff, everything the company owns that has real, measurable value. Now, assets are split into two main buckets, and it all comes down to time. The first bucket is current assets, and the magic number here is 1 year. These are all the things the business plans to use up, sell, or turn into cash within the next 12 months. And this isn't just an accounting detail. It tells you a lot about a company's ability to pay its bills right now. So what kind of stuff are we talking about? Well, the most obvious one is cash, of course. Then you've got accounts receivable. That's just a fancy term for money that customers owe the company for things they've already bought. You've also got inventory, which is all the products sitting on the shelves waiting to be sold. And then there's prepaid expenses, like if you pay your insurance for the whole year upfront. All of these are expected to become cash or get used up pretty soon. Now here's where it gets really interesting. An item's classification totally depends on what the business plans to do with it. Take a car, for example. If you're a consulting firm, that car is a long-term tool to get you to meetings. But for a car dealership, that exact same car is inventory. They plan on selling it, and fast. So you see, the balance sheet isn't just a list of stuff. It's a reflection of the company's strategy. And the other side of that coin is, you guessed it, long-term assets. You might also hear these called non-current assets. These are the big ticket items, the resources that are built to last and are going to keep providing value for way more than just 1 year. This is the heavy-duty stuff, the factory building itself, the giant machines on the assembly line, all the office furniture and computers, and yeah, that consultant's company car we just talked about. These are the assets used to actually run the business day in and day out, not to be sold. Okay, so beyond the basics, there are a few really fascinating types of assets that tell a much deeper story about what a company's all about. These are the ones I find really cool. First up, restricted cash. You'd think cash is cash, right? Well, not always. This is money that the company technically owns, but it can't actually touch. It's been legally or contractually set aside for a specific purpose, maybe for a future loan payment or as part of a legal settlement. So because the company can't use this money for its daily operations, it's not a current asset. It's effectively locked away. And that's a really important clue for us, because it shows the company has serious commitments it has to honor, which gives you a much better feel for its actual financial flexibility. Next, we've got one of the most valuable categories in the entire modern economy, intangible assets. Just like the name says, these are incredibly valuable resources that you can't physically touch. But honestly, they can be the entire reason a company is successful. This is where the competitive advantage lives.
We're talking about the power of ideas and reputation here. Think about it. A patent on a groundbreaking invention, the copyright on a piece of software, or a powerful trademark like a famous logo that gives you instant brand recognition. In today's world, these untouchable assets can be worth so much more than any physical building or machine.
Okay, so we've covered everything a company owns. We've gone through the assets. Now let's flip over to the other side of the equation and look at the claims against those assets. This side is broken into what the company owes to others, the liabilities, and what's left over for the owners, the equity. First up, let's talk liabilities. And hey, just like assets, liabilities are also split by that same one-year timeline. So current liabilities are all the debts and obligations that the company has to pay off within the next 12 months. This number is super important because it's a direct measure of the company's short-term financial pressure.
We're talking about the day-to-day debts here. Accounts payable, which is money owed to suppliers. You've got any short-term loans, wages that are due to employees for work they've already done, and of course, the big one, taxes owed to the government. All of these have to be settled within a year.
And then you have the long-term liabilities. These are the bigger financial commitments, the ones that don't need to be paid off in full for more than a year. They often represent major strategic decisions the company has made to finance its growth. Think of the really big stuff here. A multi-year bank loan they took out to build a new factory, the mortgage on their main office building, or maybe bonds that the company sold to investors that won't mature for years and years to come. So when you step back and look at the whole thing, you see it, the full story. On one side, you have everything the company owns, its assets. And on the other side, balancing it perfectly, are the two claims against those assets. First, what it owes to outsiders, its liabilities. And then, whatever is left over, that's the equity. It's the value that belongs to the owners. And that equity isn't just some random leftover number. It represents the company's true net worth. And the fact that these two sides are always in perfect balance, well, that tells a complete story of risk, value, and health, all captured in that one single snapshot.